This is Sahil Kapoor, and welcome to yet another edition of DSP Netra. Today, we are going to discuss the Feb 2025 issue for DSP Netra. And every time we write this report, the endeavor is to write a forecast tree and a report which is not trying to predict anything, but largely to showcase what the history says and try to garner whatever lessons we can from history and see how it can help us in investing better. So in this issue also, we'll try to look at data from a historical lens. Some of these lenses could be distorted or biased, and we try to minimize those bias all the time and try to remove that so that we are able to present a data set which is comprehensive and also insightful. Throughout the presentation, I will be going through all the slides. If you have any questions in between or right now, you can use the Q&A button at the bottom and you can put the questions. If you have those questions right now, you can put those questions. At the end, I will take all these questions collectively and try to answer them. So we will straight away jump into DSP Netra. We'll try to look at all the important parameters on in this report, the Feb edition of DSP Netra. So first is we will look at some historical data points, which is what is called History's Handbook. Effectively, there are three sections that we have divided this report into. One is History's Handbook, which will talk about some historical data points. Second, we'll talk about US equity market. What are we seeing and what are some critical data points saying? Third, we'll talk about India's growth, which is a often discussed subject, but we will talk about it in some detail. So first is History's Handbook, and this has three sections. First one tells you how equity markets behave in different cycles. So what we have tried to do is look at data and try to see whenever markets go through a bad phase or a deep correction phase, whether it is in India or in United States, because these two are markets which are utilized or probably the best performing markets globally. So their worst phases are also better than other markets. So it gives you some indication on how performing markets behave when they go through a bad phase or their worst phase. So we've taken some data points you can see from 1993 onwards for India and from 1970 onwards for United States. You can see that in 93 and 96, our best and worst, all data points are colored because of the scam of 1992. The market went on performing till about 1994 before it peaked out. But the numbers in that era is so distorted from reality that even the worst readings are matching some of the best readings that we had later on. So with that, probably hindsight, we know today, those numbers are slightly distorted. Even then, you can see that one very clear takeaway that when markets go into a corrective phase or go through a large decline, usually at their worst, they behave and give returns which are lesser than the bond market. You can see that, for example, in 2001 market decline, the 10-year CAGR for Nifty went to 4%, while FD returns in that era was 12%. So 10-year FD returns for, let's say, a 5-year maturing FD is what we have taken. You can see it was giving 12% returns, while equity returns on a 10-year CAGR basis became 4%. You can see 1 year, 3-year, 5-year also became negative in these eras. Certainly in other eras also, for example, a 2009 decline, 10-year CAGR still remained at 8%, although it was lower than the bond market CAGR. Right? Similar numbers you will be able to see in United States. These are not exact readings. You will see that in some cycles it will happen where equity returns will come below bond market returns or they will come very close to bond market returns. For example, in United States, you can see 2001, 2002. In this period, the returns were similar or still superior than the bond market. In 2009 decline, they were significantly inferior than the bond market. But the key point here is that large decline in stock markets occur. One, they become very, very expensive. In the post era of those expensive market, you will see that markets will go through a phase where they will over time become cheaper. And from that expensive phase, they will deliver returns either equal to or less than the bond market returns or vicinity of the bond market. but they will remain as volatile as equity market. So if you were to put a line, single line of what we have written here is, at their worst, equities earn bond-like returns with volatility similar to that of stocks. So this is quite true in almost all countries. In many other countries, it is even worse, where stock returns are much lower than the bond market. For many countries where bond returns are also 0 to 1%, equity returns were even inferior to those numbers. So we have not put those countries. Maybe in the future we'll try to put them. But the message is clear that if you buy stocks when they're expensive, effectively you are buying bonds, bond-like returns, but volatility like stocks, which is not a great combination. This also gives you another message that when you see that the 10-year CAGR for equity market goes and matches the bond market, that is the point where somewhere the odds begin to favor equities once again, right? And those numbers will become very interesting as you go along. And they also serve as an indicator of how equity markets mean revert over time, because bonds or FDs don't mean revert. They remain at the level where the interest rates are prevailing. So the second slide, again, historical sneak peek. We have put this data earlier also. You can see that it talks about how it's not very easy to outperform gold. You can see two very distinct tables here, one for developed markets. There is a slight mistake here. Indonesia should be part of the emerging market, although it features here. So it should actually effectively be in this bucket. And South Korea should be in this bucket, which is a mistake on our part. But when you look at the data, you will see that gold's excess return in each of these countries is significantly high. That means gold has beaten domestic equity in local currency terms in almost all markets of the world, except for India and for Australia. And you can see that in case of India also, these numbers have started to become smaller. When we published this data back in September 2023 for the first time, the difference was around 1.5%. And then since then, 60 basis points have been given up. In fact, on a 10-year rolling basis in India, adjusted for inflation, gold is now giving a higher return than equity, even in India. So this is a data point which is effectively giving you one indication that gold acts as what I have written here is a hedge against sovereign stupidity. What is sovereign stupidity? Lot of countries in the world, almost all countries in the world, whenever they face any economic problems or hardships, they print money. Whenever they print money, increase their debt, increase their fiscal deficit year on year, and accumulate more debt, it causes debasement of currency. And whenever debasement of currency happens, currency weakens, gold prices benefits in local currency terms. And that is what sovereign stupidity is, that many countries want to get out of trouble by spending more and more, by taking more and more debt. And that is one of the reasons why their currencies suffer. And this is what we've seen. In fact, one currency which has not significantly suffered versus all other currencies is the US dollar. Over the last 30 to 40 years, US dollar has actually appreciated against a basket of currencies globally. Still, gold has done much better even in US dollar terms, because US dollar on its own, on an absolute level, has debased by its own inflation, right? So, in fact, gold has acted as a hedge against most other currencies, including the dollar. And that is why I've written sovereign stupidity. One more interesting table, which is there in this slide, is on the number of stocks which have outperformed gold. You can see that India has 43% stocks outperforming gold in the NSE 500 basket. But for many other countries, the numbers are very small, right? Very few companies have been able to outperform gold, which means that even for very smart stock pickers, it's not very easy to figure out a portfolio which can outperform gold over a very long period of time. And therefore, we have repeatedly made this argument that keeping some allocation to gold becomes a logical step to diversify in your portfolio. We have seen a large rally in gold in last 8 to 9 months. It has rallied nearly 50%. If you go back to, let's say, our September, October issues in 2023, you will see very similar data points on gold, but the prices are now very different than they were back then. But still, I think it is still early days for precious metal bull market. and allocation to this metal over the longer term. Longer term means when I present data for 25 years, I suppose that the takeaway is that we are talking about 20, 25, 30 years of allocation. That is what it means to allocate to gold. The third slide is about tariff, and in the last week of Jan and early Feb, we had a lot of discussions around the tariffs that US was imposing, the new administration was imposing globally. Although it took back some of those tariff impositions on Mexico and Canada, but not on China, which is what is significant. So therefore, the talks or the discussions died down. But this is a sneak peek, or going back in history and seeing one of the most crucial tariff legislation to have happened, which is the Smoot-Hawley Tariff Act of 1930. And this was the act which was enacted back then, and the reason for enacting the act was that US wanted to protect its farmers from global imports, and it wanted to make its own domestic farming and industry or manufacturing better versus the rest of the world. So therefore it created a protectionist mechanism by raising duties. You can see that US weighted average tariffs on imports, you can see in 1930s hit a all-time high. And at the same time, when they imposed these tariffs, the US trade deficit, which actually should have improved, it actually became worse, right? In fact, global trade, which is countries trading with each other, fell significantly. You can see that global trade fell significantly, and the reason for that happening was that once US enacted tariffs, it imposed tariffs on other countries. All other countries also retaliated. They also imposed high tariffs. So there were big walls, big tariff walls across the world, and because of which the global trade fell. Which means that tariffs are not the best way to, impose, let's say, international trade regulations, and it has somewhat backfired in the past in terms of slowing down global growth. But also, please, by no means I'm saying that tariffs are not useful. Okay, tariffs are useful so as to create a more powerful or more robust domestic economy. They can force companies or countries to find resources internally, but that is a very different topic. It can create a better outcome for a country, but tariff war, when they are imposed in a globalization or global standpoint, initially will cause a lot of pain. And this is one sneak peek from history which is available to us. And there are two or three other such instances utilized by some other countries where the outcomes are very, very similar. This time, we are seeing that US is repeatedly, at least in the narrative, trying to say that they are going to impose tariffs. And these tariffs, what they're talking about or imposing, are also at lifetime high. They're very high tariffs, and it has the ability to derail global growth, specifically when US is trying to curtail its own fiscal deficit. So it is trying to curtail its own spending. I spoke about this in the last two or three instances also. Um, More recently, even the US Fed has said that I'm not going to cut rates as fast as I was doing earlier. They are sort of taking an early pause. So you take an early pause on monetary policy, you cut back on fiscal expenditure, and you impose tariffs. This is again a recipe for slowing down your own growth and global growth as well. So be very careful with these announcements when they come. If they are materially higher, if they impose tariffs like 20%, 25%, these numbers are very high. If they're imposed on blanket goods and services, they can cause serious damage, specifically when other countries retaliate. So this is a historical standpoint or historical context of looking at the same thing. You can, of course, read about it more. One of the best books to read about how 1930 came to be, and also read about the angle from gold-backed currency or the gold standard and tariffs is a book called Golden Fetters. I think it's one of the must-read books. It's a tough book to read, but will give you a very good context on how things panned out at that time. So we'll now move up to the second section where we talk about some signs or cautious signs for US equities. Um, First is where I talk about junk bond yields. What are junk bond yields? So, non-investment grade bonds in US, or you could say junk companies, which raise money in the debt market. These companies, whenever they raise money, have to pay a premium over, let's say, US Treasury. And this ratio that you are seeing right now, which is ICE BOFA US High Yield Index, these numbers, for example, this 5% number indicates a 5% spread, over the US Treasury, right? And so these numbers will tell you how far is the market perceiving risk for high yield debt, and how much premium does it want. You can see right now the spread is at one of the lowest levels, currently 2.7% higher than Treasury securities. This is effectively maybe the second lowest level. The lowest was in 2007. Um, One of the lowest readings that we've seen on record. What does this mean? It means that the market is not pricing any significant risk from junk bonds. So, on the face of it, this is a very positive data point. It tells you that there is no risk per se in the credit market right now. Everything is good. And at the same time, it also indicates that there is a lot of complacency, which means that the market is not prepared for any surprises whatsoever in the credit market. And you can see that historically there has been a lot of up and down in these spreads, and these spreads go up significantly very, very fast. For example, I've shown that in 2007, just ahead of bear stearns, they were at all-time low. Within 3 quarters, they spiked up so much that the overall credit market completely collapsed. But it was one instance. Maybe I don't know whether in the future it will repeat or not, or repeat with a bigger intensity. We have no clue to judge. But we have this data point that you are already sitting on the other extreme, which means that you are sitting on the best possible outcome that can happen. And over the last nearly 4 years, we have shown repeatedly that what comes after best is not so best, which means that if you're already sitting on the best, usually the next outcome is not as best, or it sometimes becomes the worst. So we have to be very careful on how these spreads play out. And I also wrote a very short note on, convexity of interest rates. And it's a very, very important topic, which means that interest rates are non-linear. What does this mean? That uh, rate of, let's say, rate move of 50 basis points. For example, let's assume interest rates are at 1% and they move to 1.5%. And case B, rates are at 5% and they move to 5.5%. Both the moves are of 50 basis points, but their impacts are significantly outrageously different. So a move from 1% to 1.5% may have no impact or very minimal impact on the economy or the credit market. But a move of, let's say, even 5 bips of 5% to 5.05 will have very, very different, sometimes catastrophic impact on the economy. And the reason is that as soon as cost of capital rises, the ability of businesses to make higher ROE does not rise as faster. For example, in an economy, if on an average companies are able to make, let's say, 15 or 20% ROE, and interest rates are at, let's say, 7 or 8%. If you raise rates, let's say 200 basis points, and start sitting at 10%, the ability of competition to make higher ROEs will get compromised. And every single basis point addition in interest rate will cause businesses to, squeeze liquidity at a much faster rate. It will become much more difficult for the economy to absorb those small interest rate hikes also. And therefore, when you think about it on the opposite end also. So, for example, as I said, these spreads are very, very good. We haven't had them at this level, which indicate that the credit market is in an excellent shape, which means that balance sheets for most of these companies are so good that even junk companies are able to raise rates only 270 basis points above US Treasury, right? So, which means that either their balance sheets are exceedingly good, or the liquidity is so abundant that everybody is ready to lend. Now think about this: whenever rates, even in this environment, fall, or these spreads fall, even by 5 basis points or 3 basis points, it tells you how more and more complacent the market is becoming, not by just a small magnitude, but by orders of magnitude, by a very large magnitude. And that is what is concerning when you hit these all-time low numbers on spreads, which is where we are today. What does it convey? That the credit market is totally unprepared for any unknown, uncertain event, and we do not have any dearth of new triggers happening, right? Whether it is tariffs or these are all known unknowns, but unknown unknown event, which is uncertain and unknown, can create a much bigger impact given where these credit markets are. So it's a sign of caution. Um, the second is the valuation and price differential, which has been created by the stock market rally in US. You can see that we've taken data back from 1871, taken a rolling 10-year data for S&P 500 price CAGR and also 10-year CAGR for EPS. So we took a 3-year average for EPS. Otherwise, these readings will get distorted because there are certain years where EPS became zero, uh, even negative in 2008 for the S&P 500 as a whole. So it will distort these numbers and make the lines on a YOY basis or even a 10-year CAGR basis absurdly up or down. So we took an average, and you can see that whenever this orange line and the blue line disconnects, where the stock rally much ahead of earnings over a longer period of time, eventually they mean revert and go back to where earnings are. So in the very long term, you can be rest assured that stocks will follow earnings, and you can see the trend, the line is upward sloping, which means that over a very long period of time, earnings have gone up and therefore stocks have also gone up. But there are many periods where the growth for earnings will falter, and then stock markets eventually will come and mean revert towards where earnings are growing. And we've seen that disconnect play out over the last 3 to 4 years where stocks have rallied significantly. You could also rename this or rephrase this as PE re-rating. You would have heard this phenomena even in Indian markets again and again, that in the last 10 years, let's say a average Nifty PE, which used to be 15, 16 times, the average has itself gone to 18, 19 times. And this is the same thing which has happened in US. From 1871 to today, the average is about 16 times price to earnings multiple. When you look at last 30 or 40 years, the average is about 18 and a half times. When you look at last 20 years, the average is about 20 times. Currently, they trade at 24 times. So not even the current earnings or current P ratio, even the averages have gone up. And this is what happens when short term means when you look at 150 years of data or 200 years of data, even 2 decades are short term, right? So this increase in price to earnings ratio, even if it looks permanent on a 20-year basis, is still temporary when you look at it from a long-term basis, and they mean revert. And currently, we are in United States far away from these numbers. The reversion, roughly, when you look at just the P multiple, is from, let's say, 24 to 18 or 16. I don't know where it will settle, but that is the mean where it can come back to as it has been historically. So this is again a risk where stock prices have rallied much harder than earnings. So either one has to mean revert. And usually we see that stock prices are much more volatile, and they move much more than earnings. So earnings are less volatile. Therefore, the ability of stock prices to remain high and earnings to catch up, that probability is much lower. Now we go to the third section, which is India's economic growth. Again, a very, very important section. And so first we'll check out this 8% number. And more often than not, I think we read in the media that India needs to grow at 8% or India will grow at 8%. And this number is used again and again. In fact, when we look at many economic projections being made, some projections say that India will grow at 8 or 10% and therefore reach 30 trillion or $50 trillion of GDP. But when you look at the past data, you will find that 8% growth is not very easy, right? So one current debate is that India has to reach $30 trillion of GDP, which is again a narrative based on, let's say, a trend line growth. And so when you calculate it, it will take 25 years at 8.5% CAGR to reach 30 trillion from where we are today, right? So how easy or difficult it is. So when you look at the past data, you will find that all the green highlights is the years where India has grown at more than 8%. You can see that in the 80s there was 1 year, in 90s again there was 1 year, and then in 1991 to 2000 again one single year. In this era, we had very good years where we had 7.9, very close to 8% growth. So this was a year where this was the phase where the whole world was growing at a very fast pace. We also grew at a very fast pace, but we grew above 8 only once. And similarly, in this phase, we had two eras where we grew above 8% for 2 years. FY16 was just about below 8% at 797 or so. Even in the current decade, which started in 2020, we've grown at about 9.7 and 8.2. But you can see many of these numbers come, let's say in FY22, we came out of a negative base, so we grew faster. Uh, Even in the years after FY9, we grew at 7.9 and 8.5. We came from a global financial crisis. 89, we came out of a drought year in 1988, right? FY 2000 again was a good year. There was no crisis prior to this year. The whole world grew at a very fast clip. So similarly, two things. One, many of these large uptick years are preceded by some sort of a crisis we've seen, and that sets the tone for higher growth. But our ability to grow at 8% is significantly lower than the current narrative that you hear. We haven't done that in the past at a very fast pace or a very steady pace. Second thing is that as the GDP size becomes bigger, for example, growing at close to 8% in '04 to '07 or '08 phase, our GDP was a trillion or lower. Right now, we are getting closer to $4 trillion GDP. Somewhere in 2025, we'll probably reach that number. So it will be much harder to add 8% growth on top of, let's say, 8% plus inflation on top of a $4 trillion GDP number. Right? So real GDP growth of 8% is going to be a large challenge, even if we grow at 6%. So what is our growth rate from 1991, which is the year where we introduced a lot of reforms in India, until today, it is 6% CAGR. Exactly, 6.04% to be precise is our long-term growth rate from 1991 to today. And it's an excellent number. It's a very good number to have. Very few countries are able to grow at this pace. Even if we do 6%, I think it will be an excellent outcome if we are able to maintain it. It will cause a widespread growth across all sectors. And therefore, we need to rethink about what are the numbers we think. And why is this number important? If you are going to grow at 6% real GDP growth, I have no clue at what rate we'll grow. We do not have any forecasting ability. As I said, from 91 to 25, we've done this number. Can we do this in the future? I have no clue. But if we repeat it, let's assume that, then 6% real growth, let's say 4%, which is RBI's inflation target, 10% nominal growth. Corporate earnings will also grow between 9 to 10%, which is the historical norm when you look at the GDP, because exporters are roughly not growing as fast as India's growth. Therefore, blended growth will be at this number. And therefore, market returns could be better than FD returns over a very long period of time, which is what is the case that equity delivers higher returns if they're able to follow the earnings. And therefore, even 6% number is a good growth number, but 8% is going to be very hard. In the years where we grow at 8%, you can see markets rejoice and do extremely well. But those are very rare years, as you can see from history, and therefore we need to realign and rethink about our growth numbers, or at least not our growth numbers, but our expectations about growth. Second is where we are in the cycle currently. So we saw some slowdown happening. In fact, you will remember that a few months ago, we wrote a slide in Netra called Slowing, where we showcased a number of high frequency data points which were slowing. You can see that that slowdown has now shown in the GDP numbers. And where have we come to? So we plotted the percentile numbers of GDP growth rate for every quarter. So we take each quarter and look back 12 months. So every quarter is a 1 year look back. And you can see currently we are at 50%. So which means that half of the time we grow faster than this number, half of the time we grow slower than this number, which means that we haven't really entered any kind of a slowdown right now. We are just middling. We are at the center. Possibly the slowdown would be ahead of us. I don't have the forecastable ability whether this will turn up or down from here, but the indicators, at least which are there, or the live indicators or high frequency indicators that we have, most of them continue to remain subdued. The uptakes, if at all, are very small, and most of them still indicate that we are in a slowdown phase and probably slowing than what we were doing earlier. So these are some of the numbers, and therefore also I think now, for example, today the central bank did a rate cut, possibly in acceptance that slowdown needs to be acknowledged and probably worked upon. So currently, uh, the data tells you that you have still not entered slowdown, it is still ahead. Third is that when you look at the economic growth trajectory, currently there is no cycle in the economy. Economy is very cyclical, and each cycle creates a lot of opportunities. So what do I mean by cycle? So we've taken three numbers here: nominal GDP, PFC, which means that consumption, which is the green line, and GFC is the gross capital formation, which is the brown line here, or the dark orange line. You can see blue is the nominal GDP. In each of the cycle, you can see there is one or the other leading. For example, in the noughties or 2002 to 11 cycle, investments, capex, and GFC, it led nominal GDP. It grew at a much faster pace than the nominal GDP. Businesses were investing in the hope that there will be very strong demand. And even the private consumption numbers were quite strong. You can see the 5-year CAGR at the peak was closer to 15% for consumption, not as high as investments, but again, the investments were the leader of that rally of the economy at that point in time, right? Then came the next cycle where we went through a crisis in 13, 14. Then the economy made a comeback. You will remember that 2000 FY17 had an 8% GDP growth year, right? In that cycle, consumption was the leader. It was growing at a faster rate than GDP. And you will also remember that a lot of consumption stocks did really well, right? Although investment stocks or capex stocks did not do well, or whatever you call that sector particularly. Currently, now we are in a cycle, or in an anti-cycle, where the leader is unclear. Everything is growing at the same pace, right? You can see that almost all three components, all two components are growing as fast as the nominal GDP. So currently, when you think about, let's say, an intervention from the government, which is a counter-cyclical intervention, or from the central bank, it is still unclear as to what needs to be propped up. Is it consumption or is it investment? Because both are growing at the same rate, and both are growing at the rate of the nominal GDP itself, right? So currently the cycle is missing. It will emerge. Of course, it will emerge on its own, not by any construct or policy decision, but it will emerge on its own. It's a bottoms up property. Nobody, no policy maker or a single sector or a corporate can dictate this cycle. It happens on its own, and it will become visible in data over time. But as of now, the cycle is missing, which also tells you that the rebound that we've seen in growth is still missing a cycle. We do not know what the leader is. It will probably emerge in the future. More often than not, when the cycle is missing, even the remedy is unknown. You don't know how to correct it, because you can't foresee what the problem is, right? And therefore, when you look at the overall economic trajectory in India, the growth appears to be slowing at a steady pace, as I said, around 6% or so, which itself is a very good number, but much lower than what the market expectation or what the valuation expectation of stocks is, which is a growth of upwards of 8% or maybe 8.5%. That is what the market is pricing in, but that is not what the data is showing you. The next is a very, very important two-slide explanation on what has happened in the housing market, or why is it such a very, very important dynamic component of India's economy. For example, if you were to take one single data point which could be material and significant in all cycles in India, it is this data point. What does it tell you? I'll give you some broad numbers. Indian economy is about 300 trillion or 300 lakh crores. Out of that, 30% comes from investment, or GFCF, or gross fixed capital formation. What does that mean? 30% comes from creation of fixed assets. What are those fixed assets? Creation of homes by household, or gross block addition, which means factories and plants by private companies, or by government expenditure on infrastructure like roads, railways, ports. So any fixed asset that you think in the economy is part of this equation. So 300 lakh crores is the GDP. Out of that, 30%, roughly 100 lakh crores, 100 trillion rupees is this investment number. Out of that 100 trillion, roughly about 30 rupees or 30% comes only from home construction, which is a very large component, which means 30 divided by 300, it is roughly 10% of our GDP. And we are not here adding the ancillary services. When you build a home, there are many ancillary services also which are utilized, which is not part of this number. So the overall impact will go way beyond 15 to 18% on GDP. So it's a very large component, a very important component of India's growth. When you look at these slides, you will be able to make out the numbers. I mentioned all the numbers in the slide. You can dig deeper and look at this number. Now, what is the connection of these numbers with the market? So one, over the last 4 or 5 years post-COVID, you have seen that real estate activity, particularly home sales in India, has gone through the roof. The activity is very, very strong. In fact, up until November and December, the numbers which are available till now, for example, stamp duty numbers and number of transactions which has happened, they continue to remain at lifetime high. What are these transactions? Home sales, right? But look at one very critical number. Even when home sales have gone up, you can see the chart on the right, you can see the total absorption number, which means that the unit being sold are rising significantly. These bars are going up. New launches are also rising significantly. Inventory is declining, which means that huge amount of demand has been created for homes. But at the same time, look at this number, which is housing loans as a percentage of GDP. No change over the last 4 years. They have not moved an inch, right? Hardly any change. They are growing at the same rate as the GDP, although home sales and this sector is outperforming the overall market by a very wide margin, right? And similarly, what is going up? Personal loans, right? So personal loans have gone up significantly, and this number is, possibly causing a huge amount of, other type of consumption which is going up. For example, for white goods and for brown goods, right? But one critical factor is that when personal loans are going up, incomes have not gone up significantly. You can see that we put here non-housing personal loans, but PFC, which is private consumption and corporate sector compensation to employees, it has not gone up significantly, right? But personal loans have gone up significantly. So you go back to November 2024, where RBI governor made a comment that there is no hard data establishing that funds from unsecured loans, which is this part which I showed, personal loans, are significantly entering the stock market, but anecdotal indications suggest this could be happening. We are very watchful of that segment. Estimating the exact amount is very difficult, right? So there is a possibility that some part of levered stock market gains or unsecured lending has probably entered the stock market because the profitability or the churn rate of profits was very high, which means that uh, people entering the stock market were able to make quick profits. That money was probably being utilized also in the real estate activity, which means that you make profits in the stock market, use that money, use those profits, and probably build back and utilize that money in the real estate sector or housing sector. But this is a theory, it's a conjecture, maybe also indicated by regulators to some extent, also visible in numbers. Now, what is the significance of this number? That when stock market profits dry up, right? As you can see that trailing or 1 year rolling returns become negative, this ability of the market to finance this sector will go down. You will no longer have these profits, and any which ways the housing loans or home purchased on through borrowing are not going up. So therefore, in personal loans again has also started going down, where the regulators clamped down on unsecured lending. You will remember 6 to 9 months ago, the Reserve Bank of India clamped down on unsecured lending, and that has also started becoming visible in banking lending numbers. So when you put all these data points together, it tells you that there is this very specific sentimental or sensitive node between the stock market and the real estate or home, or particularly the home construction housing sale market, which is very sensitive. If stock markets don't churn out profits at a much faster rate, this part of the economy can also see some hit. It will not be significantly high, but incremental numbers could be lower. And why am I mentioning this number? which I mentioned in the last slide, that it is a very large part of our economy, almost 10%. And the linkage, although entirely logical, legal, and of course, where people make profits, they utilize that money to buy other assets, which is one is real estate. But if incrementally it slows down, it will have a significant repercussion on the economy also. And this is the linkage of how stock markets or become reflexive for the economy. They can go back and build back channels and impact the economy. And this is still a theory because real estate numbers are still strong. We'll come to know maybe over a 6 months period or what is the impact on overall these numbers because currently they have not slowed down. And second is that even the market decline is still very small. It is not significant enough for these numbers to decline. If there is a significant decline, then possibly we'll see this node coming under pressure. So it's more like a monitorable for now, but a very important one. The next slide is on where margins and earnings are sort of, about the markets right now. The bottom two charts, you can see that the revenue for the market has slowed down, sales growth. It has come down to single digits. It was upwards of 20-25% back in 22, early part of 23. It is now closer to between 7 to 8%. PAT growth, which was very high initially after the COVID rise, then with the base effect it fell, but again went back to 20% growth or so. Now it has come to about 13-14% and possibly slowing down to high single digits in the next 2 quarters. And what is the reason? Margins. You can see this up the chart on the upper panel. It has two lines. The blue line, which is the net profit margins of listed non-financial companies, right? Which is on the left-hand scale, closer to 8 to 9%. These are non-financials only. And there is India WPI minus CPI. Whenever WPI minus CPI goes down, usually margins follow that trajectory, where corporates' ability to pass on the cost goes down significantly. So margins are already at the peak, and there is a good likelihood that we'll see, margins decline further as we go from here. So when sales growth is slow or slowing, margins are likely to contract from where they are. They are already at a very, very good pace. There is a good possibility that profit growth will also slow down. And this slowdown has, I think, possibly materialized in last 2 quarters and possibly will materialize in the next 2 to 3 quarters as well. So which tells you that if profit growth is going to be, let's say, high single digit or low double digits, then the ability of the market to trade at 20 time plus is going to get challenged. So when you, let's say, only look at Nifty, which trades at about 21.5 times trailing earnings, if you remove banks, which trade at about 13 times, because we are talking about non-financials here, the rest of the Nifty trades at about 27-28 times, right? So anything which trades at 27-28 times at an ROE of 15% or so, or 15.5% or so, it will be very hard for it to maintain that valuation number if the profit growth is just about 10-12%. So this is the overall trajectory where the market is, which means that there is a lot more derating, which is possible for stocks, specifically in the mid and small cap space, because in that space, the valuations are higher than large caps only. And right now, we are only talking about large caps here. Right? So that is something that we need to be very cautious about, which means that the outlook for earnings and possibly even for prices still remains very muted. The last is about the rupee. We have seen some depreciation on the rupee. It has moved from being in the range of 82 to 84 for about 2 years. It remained in that range. You can see that we haven't seen this kind of a range trade for rupee for a very long period of time. You can see that this chart is from 2002. It continues to be very volatile, up or down, but in the last few years, it was just not moving at all. And now it has seen some depreciation. And in spite of RBI selling almost $20 billion in November and December, we haven't seen depreciation, going down. So this sort of a move for the rupee possibly is also a factor which will play out on our policy making. We saw a 25 bips rate cut today. although liquidity measures were already announced in the end of January, and more promises are made that liquidity situation will remain benign, close to neutral. We also had a rate cut, but any which ways, it will be a factor which will play on policymakers' mind on how far they can push the pedal on reducing interest rates or introducing more and more liquidity, because the rupee still remains slightly overvalued, and there is a possibility that it continues to depreciate, specifically because you're seeing so much strength in the US dollar and threat of tariffs globally. So this will remain an area which will possibly deter, foreign flows for FDI or FPI, either ways, and remains a key monitorable for us. Once the rupee depreciates, I think it creates a very, very conducive environment where once again foreign money will start flowing in. What that level is unknown today, but of course, some amount of depreciation is very good for the long term for attracting useful foreign capital. So these are some of the insights from what we highlighted. This is just a last slide which we utilize to send a behavioral message. This is a list of what we call Lindy stocks, which is a concept which Nicholas Taleb has given out on in his book, the Insertos series, particularly in anti-fragile and skin in the game. And you can see that Lindy is an effect which says that if something has lasted for X number of years, it has the ability to last in the future also. So if something is 100 years old, then possibly you can make an estimate that it may last another 100 years. If something is only 1 year old, its ability to last 100 years is unknown or very hard. So the older something is, its ability to last for a very long period of time is higher. Maybe let me give you a non-market example. For example, now the world has woken up to fasting or intermittent fasting, which is a concept which is thousands of years old. And it has lasted for such a long period of time that that concept or idea may last for another thousands of years. And this is what the Lindy effect says. We also looked at companies which at least began in 1905 and at 2005 at least had completed 100 years of being incorporated in India. They would have listed anywhere, but they should have been incorporated 100 years ago. We took such companies, and you can see such companies have outperformed in India all other stocks put together or the broader market by a very wide margin. And this tells you that time, which is a big leveler, it levels everybody. If any company or idea or thought can survive time, there is a possibility that it has some inherent strength and possibly it will keep on going for a very long period of time. This also sends a message that chasing new trends and fads may not be the most ideal way of investing or way of churning out ideas. In fact, sticking to very old time tested, and time tested has a very strong meaning because time destroys everything over time, which is fragile, which is not very strong. And if something has lasted for a very long time, the probability that it will last for much longer is very high. And this is what the Lindy effect also shows. Therefore, long-term investing with long surviving ideas is a very good way to invest. And with this, I will stop here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.